Hello, welcome to my channel. In this video, we are coming to look at the consolidation of foreign subsidiaries. So, when you have a foreign subsidiary, you are supposed to consolidate the results of such a subsidiary when you are presenting your consolidated financial statements. And there are rules regarding the consolidation of foreign subsidiaries in consolidation. So in this video, we are coming to do just that. If you are new on my channel, kindly subscribe to my channel, and please don't forget to like the video if you find it useful, and don't also forget to leave your comments in the comment section so I can know exactly what you think about my videos. Alright, so before we proceed, let's look at some key definitions provided by IAS 21, which deals with foreign currency. Foreign currency. So the accounting standard IAS 21 identifies two key types or categories of currencies. So we have the functional currency, and we also have the presentation currency. So what is the difference? The functional currency is the currency of the primary economic environment where the entity operates. So the currency of the primary economic environment in which a business operates is what we call the functional currency. So the currency in which you undertake your sales and purchases, undertake your transactions, okay, that is what we call the functional currency. And in most cases, this is your local currency. So if you are situated in the US, the US dollar is your functional currency because that is the local currency and it is the currency of the primary economic environment in which you are operating. Then the second category is what we call the presentation currency, as we have here. So the presentation currency refers to the currency in which the entity presents its financial statements. So there is a functional currency, which is the currency of the primary economic environment or the currency of the locality in which you are operating, and the presentation currency, which is the currency in which you present your financial statements. So when we talk about foreign subsidiaries, we are saying that where the functional currency of the subsidiary differs from the presentation currency of the group in which the subsidiary belongs, then the financial statement of the foreign subsidiary must be translated before consolidation, because in consolidation you are presenting the financial statement of the group as a single entity. Hence, the financial statement should be presented in the same currency. And so this is the need, or this is why there is the need for us to translate, okay, the operation or the financial statement of the subsidiary into the presentation currency of the group as a whole before consolidation needs to be done. All right, so let's look at the consolidation procedure. How do we do that? The procedure is that one, incomes, expenses, and other components of or other comprehensive income of the foreign subsidiary are translated at the exchange rate in place at the date of each transaction. So this is referring to the consolidation of the statement of profit or loss and other comprehensive income. What you are saying is that the various items within these financial statements needs to be translated at the exchange rate in place at the date of each transaction. So when you're translating sales, we are taking the exchange rate that was in place before the sales took place. Okay, but in practice, this is quite difficult to obtain. That is why there is this caveat here that the average rate for the year may be used as an approximation, okay, as an appropriate approximation. So what we are saying basically is that we use the average rate because that is quite easier to determine at the year end. All right, so that is what we use to translate the operations of the foreign subsidiary. All right, so that is what we do. Then the second procedure is the statement of financial position, of course, and we are talking about assets and liabilities. And what we are saying is that the assets and liabilities are translated at the closing exchange rate. So since we know that the consolidated statement of financial position and even the individual statement of financial position is prepared at the end of the year or at the end of a particular period, it is consistent and it makes a lot of sense for us to use the closing exchange rate, all right, the closing exchange rate to translate such items in the consolidated financial statements. All right, so that is what we have there. So IAS 21, I want to touch on this before we continue. IAS 21 also states that we have certain items called monetary items, okay, that have to be retranslated. And then we also have non-monetary items which are not retranslated. Okay, so the examples of monetary items include cash, receivables, payables, loan notes, and all that. They are the monetary items. And according to IAS 21, foreign currency, these items have to be retranslated at the closing rate at the end of the period. Okay, and these items fall under the assets and liabilities. All right, so whenever we are dealing with these monetary items such as receivables, payables, cash, loans, and etc. like that, we have to retranslate them at the end of the period. And usually this is done in the individual financial statements. Okay. And then we also have the non-monetary items such as non-current assets, we have inventory, investments, etc. These items are not retranslated. Okay, they are not retranslated. Rather, if the item is carried at fair value, it should be translated at the date that fair value was determined. Okay, that is what we do for non-monetary items. That is just something I want to brief you on before we continue with the discussion, the actual discussion for today. All right, so what are some of the key things that we need to do when it comes to consolidation? Now we know that goodwill is a major part of consolidation. So how do we deal with goodwill? Because when we acquire a subsidiary, we need to recognize goodwill according to IFRS 3, business combinations. So how do we deal with that? So usually we calculate goodwill in the functional currency of the foreign subsidiary and then translate it like any other asset at the reporting date. So since goodwill is an asset, we are going to use the closing exchange rate, to translate the result. So what we are saying basically is that we calculate goodwill as normal as we do, and then we translate the result or the goodwill in the functional currency of the subsidiary into the presentation currency of the group, all right, for consolidation purposes. That is what we do. All right, then since goodwill it will be translated and we are going to have an opening goodwill, okay, goodwill at acquisition and goodwill at reporting date, there is going to be an exchange difference called exchange gains or loss. All right, so what we are saying is that current year exchange gains or losses on the translation of an overseas subsidiary and its goodwill are recognized in other comprehensive income. That is what we do. So this is a pro forma for us to understand what we do when we are retranslating goodwill. So we have this here, and what we are saying is that we are going to take, now the first column here is the amount in the functional currency, okay, and this is the translated amount, okay. So at the end of the period, we are going to retranslate goodwill, and we are going to pick the goodwill at acquisition date in the foreign or in the functional currency, and then we are going to apply, in order to translate it into the presentation currency, we are going to apply the opening rate, because this is goodwill at opening date or acquisition date. So we are going to use the opening rate, which will be given to you in the question. Then we are going to use that, apply that on the amount of the amount in the functional currency to be able to get the amount in the presentation currency of the group or the translated amount. And then we are going to take impairment loss, if any, and then we are going to translate that at the average rate. Now, don't forget that we say that the statement of profit or loss items are translated at the average rate as an appropriate approximation. So, since impairment loss is a statement of profit or loss item, it's going to be translated at the average rate in place at the end of the period. And then we'll get our presentation amount here. Then we are going to add the goodwill at acquisition date to the impairment loss, and then at the end of the period we are going to have a goodwill at the reporting date, and we are going to translate that as well into the group's presentation currency. Then the difference is going to be an exchange gain or loss, the difference between the closing goodwill amount and the addition of the opening goodwill amount plus impairment loss is going to be an exchange gain or loss on retranslation of goodwill. Okay, and this is going to be recognized in other comprehensive income. All right, so take note of that. So that is it about goodwill. Then, just as we translated our goodwill, we are going to translate or retranslate the opening net assets as well. And the procedure is the same, is almost the same as for goodwill. So, just as we have for goodwill, we have the net assets at acquisition date in the functional currency of the subsidiary. We'll translate that at the opening rate, since it's an asset, to get the translated amount. We are going to have the post-acquisition profit for the period in the functional currency of the subsidiary. We'll translate that at the average rate, since it's a statement of profit or loss item, to get our translated amount. Then we'll also translate the net asset at the reporting date at the closing rate to get the translated amount. Then the difference between the closing amount, translated amount, and the addition of the net asset at acquisition date and post-acquisition profit is going to give us an exchange gain or loss, and that is going to be recognized also in other comprehensive income. In our other comprehensive income. So that is what we have there. Now, we are saying that at the end of the period, the group share of the exchange gains or losses arising from goodwill and net asset retranslation above are recognized in a translation reserve. So this is the statement of financial position treatment. Okay, the statement of financial position treatment. What we are saying is that these exchange gains or losses, the parent's share of these exchange gains or losses are going to be recognized in a translation reserve as part of our equity in the consolidated financial statements. All right, so that is what we do. That is what we do. So this is what you need to know when it comes to the translation of foreign subsidiaries in consolidated financial statements. All right, this is what you need to know. Now you are coming to take an illustration, a full-blown question, and then you are going to see how we do this in practice. All right, how we are going to do this in practice. So let us look at the question, and then we are going to dive right into it. So this is our question. Okay, this is our question here. It's a full-blown question. We are going to look at it, and then we are going to see how we are going to solve it. All right. Right. So we have here on 1st July 20X1, Saint acquired 60% of our banks whose functional currency is Ds or dollars. All right. So this is dollars. Um, okay. So the presentation currency of the Saint group is the dollar. The financial statements of both entities are as follows. So we have statement of financial position, and with the statement of financial position, we have assets, and the assets include investments in our banks, loan to our banks, property, plant and equipment, inventories, receivables, cash and cash equivalents. Then we have equity and liabilities. So we have equity capital, $1 or dollar each. Share premium. We have retained earnings, non-current liabilities, and current liabilities. So we have additional information. The following information is applicable. 1. Saint purchased the shares in our banks for $10,000 on the first day of the accounting period. At the date of acquisition, the retained earnings of our banks was $500. The fair value of Alban's net assets exceeded the carrying amount by $1,000. This fair value adjustment was attributable to plants with a remaining 5-year life as at the date of acquisition. Just before the year end, Saint acquired some goods from a third party at a cost of $800, which it sold to Albans for cash at a markup of 50%. At the reporting date, all these goods remained in the inventories of Albans. On 1st June 20X2, Saint lent $1,400 to Albans. The liability is recorded at the historic rate within the non-current liabilities of Albans. Saint measures non-controlling interest at acquisition at fair value. The fair value of non-controlling interest in Albans at the date of acquisition was $5,000. An impairment review was performed and Goodwill had reduced in value by 10% at 31st June 20X2. On 1st June 20X1, Saint received a government grant for $4,000. This grant was provided as a contribution towards the costs of training employees over the next 2 years. Saint has reduced its administrative expenses by the full $4,000. Exchange rates are as follows. So we have dollar to $1. So how many dollars are making $1 on which particular date? So we are saying that on 1st July 20X1, a dollar was $2. Sorry, $2 was equal to $1. Okay. Then the average rate is 3. 1st June 20X2, the rate was 3.9, and on 30th June 20X2, the rate was 4.0. Required. Prepare the equity. Okay, so this is actually expecting us to prepare just a section of the consolidated financial statement, but we are going to prepare the entire financial statement. All right, so we are going to prepare the full-blown consolidated financial statements. So in questions, you can be asked to prepare just a section of the consolidated financial statement, but we are going to prepare everything for you to fully understand what we are doing. All right, so we are going to prepare the consolidated financial statements at the end of the period, and I already have the pro forma set up here. I already have the pro forma set up here. I'm going to leave the question in the video description so that you can download it and follow along. So it's not every time that I'll be referring back to the question in order to save time. All right. So we know that when it comes to consolidation, we need to add the consolidated statements of financial position. We add the assets and liabilities of the parent and the subsidiary or subsidiaries together. All right. So Alban is a foreign subsidiary with the functional currency in dollars, D, donated as a D. And the group parent is Saint, which has a foreign, the functional currency as dollars, and the dollars is the presentation currency as well. So we have to translate the result of Alban from D to dollars. All right, and that is what we are coming to do in this particular video. So quickly, as we know in consolidation, the first step to do is to prepare your pro forma financial statement, and then after that, you input the figures into it so that we can be able to make any adjustments and add to get the group amount. So property, plant, and equipment, you are going to insert the figures. And as I said, statement of financial position items are translated at the closing rate. All right, at the closing rate given in the question. So any consolidation that involves consolidated statement of financial position, you need to translate the result of the subsidiary at the closing rate unless the item relates to the statement of profit or loss. That is where you are going to be referring to either the rate in play at the date of the transaction or the average rate. All right, or the average rate. All right, so let us go and input our figures there. So whilst inputting our figures, you should remember that we are going to translate the result of our balance into dollars at the closing rate. All right, so the first item we have here is property, plant, and equipment. For Saint, property, plant, and equipment is 10,000, whilst for our balance is $15,400, and you have to translate that at the closing rate. So what is our closing rate? Let's go to the notes and identify our closing. So the closing rate is $4 is to $1. And since dollar is stronger than the dollar or is higher than the dollar, we need to divide the amount of cents in order to get the stronger the stronger amount in dollars. All right, so every amount of Alban is going to be divided by the exchange rate to get our dollar amount, since we are translated from from a weaker currency into a stronger currency. So we need to divide it. All right, so let's go and do that. So we have 10,000 for Saint, and then 15,400 for um Alban. But remember that is in dollars, so we need to translate it into dollars. So let me just check this and see. Okay, so we are going to divide this by 4. Okay, so let me input my equal sign there. Equals 15,400 divided by 4, and this is the dollar equivalent. Okay, this is the dollar equivalent. We are going to leave the adjustment for now. So let's just input the figures. Goodwill, we know that it's going to be a calculation, so we leave it. Inventories, what is our inventory values? So for inventories, we are having $5,000 for Saint, and then we are having 4,000 for Albans, but this is going to be translated, so divided by 4, and then let me have my equal sign there, and that will be 1,000. Okay, we will still leave the adjustment for now. All right, then we have receivables. Our receivables are 4,000 for Saint, and then 500 for Alban. That's going to be divided by 4, so We have 125 right there. Then we have cash and cash equivalents. We have 1,600 for Saint, which is the parent, and then 560 divided by 4 for our banks. So this is our banks. All right, so that is it. Then for our equity capital, we know that for equity capital, when you are dealing with this kind of questions in the exam, you always know that equity capital is going to be only that of the parent. All right, and we know that the equity capital of the parent is 10,000, so I'll put it right there. The share premium will also not change. So our share premium is also not changed because when you read through the question, there was nothing relating to share premium changes. All right, so that one will remain the same. Then retained earnings is going to be a calculation. Our workings 5. Translation reserve is going to be a calculation from the exchange gains or losses. And then our non-controlling interest too is going to be a calculation. Well, that is going to be workings 4. All right, so we'll leave that one too. Then we come to our non-current assets. So with our non-current assets, for our bank or for Saint, we have $5,000, and then for our banks is 5,460. We are going to divide that by 4, and then our current assets will have 5,000 for our for Saint, and then for our subsidiary is going to be 1,000 divided by 4. All right, so I hope you understand it up to this point. So this is what we do initially. All right, this is what we do initially. And in order to save time, you can actually come here and add everything there together. So I can have alt equals and add everything together and copy the results down. So paste it here, and then also I can leave these ones and come here as well and do the same. So this is supposed to be this added horizontally, and then I can copy the formula and paste it down. All right, so we've got our pro forma set up for us, so we can go ahead and do the various calculations and come and do the adjustments and get our final consolidated financial position. Now in the exam, if you do this alone, you should be getting, if this is a 20-mark question, you should be getting about 5 marks. All right, you should be getting about 5 marks out of the 20 marks, but just by inserting the figures and all that. So see, consolidation can be gotten easily in the exam, so always take your time and do what is needed, all right, to get the maximum ticks. All right, now we come to the workings. So the group structure, this is a parent with one subsidiary, so it's quite easy. From the question, we've been told that Saint acquired Albans for 10,000 on the first day of our so um, we have our group structure. So Saint is the parent, and then Saint acquired Albans. Sorry, so we have Albans, and what's we have the percentage purchased is 60%. This implies that our NCI is 40%. So we have NCI here to be equal to 40%. Okay, so let me try and draw some line there to indicate our issue here. All right, so this is the simple group structure. This is actually a simple group. This is not a complex group, it's a simple group situation. So we have it there. And then we know that the acquisition date, on the date we acquired Albans, was 1st July 20x1. 1st July 20x1. So on 1st July 20x1, Saint acquired 60% of our banks whose functional currency is these. The presentation currency of the group is okay. So that is the date of acquisition. So date of acquisition is very important for us to determine the post-acquisition results of the subsidiary so that we can consolidate those post-acquisition results. All right. So this 60% was acquired on 1st July 20x1. Okay, but our reporting date is 30th June 20x2. So that is our reporting date right there. This is very important for us to determine the post-acquisition period. So the post-acquisition period is actually 2 years. All right, so from 1st July 20x1 to 30th June 20x2 is 2 years. So that's the post-acquisition period. All right, so we are done with our group structure. Let's go to workings 2. That is our net assets schedule of our banks. All right, so when it comes to the net assets schedule, as we already know, we are going to have the amount at acquisition. So we have at acquisition, our net asset at acquisition. Then we have at reporting, and then we are going to have our post acquisition profit. So I can expand this a bit. Can also expand this a bit, and also expand this a bit. Now this is going to be prepared in dollars because at the end of the day we are going to retranslate it into the parent's presentation currency. All right, so that is what we are coming to do. So when it comes to the net asset schedule, we present it in the functional currency of the subsidiary. So we are going to have dollars here, D, D, and D. Okay, so what are the net assets of the subsidiary? We go to the statement and then we see that the net assets include equity, capital, share premium, retained earnings. Okay, so those 3 items there. So we have our equity, capital, share premium, and then we also have our retained so this is retained earnings. All right, so what is the amount at the reporting date? The reporting date amount is what is found on the statement of financial position. So we have 1,500 and 12,500 respectively. So we have at the reporting date we have 1,000, we have 500, and then we also have 12,500. Then at the acquisition date, we can derive those figures from the additional information given. All right, so let's come to the additional note 1. Since purchased the shares in our banks for 10,000 on the first day of the, so this is the purchase consideration that is going to be used in goodwill calculation. At the date of acquisition, the retained earnings of our banks was, so at the acquisition date, retained earnings was $500. D, right there. And the other items have not been, nothing has been said about the other items. So the assumption is that they remain the same. Okay, so they remain the same at this particular date. So we just repeat that there. All right, now let's continue. There are a couple of adjustments we need to do here. So let's continue. Now, it has been said that at the acquisition date, the fair value of Alban's net assets exceeded the carrying amount by $1,000. This fair value adjustment was attributable to plant with a remaining 5-year life as at the date of acquisition. So we are going to have a fair value adjustment. Fair value adjustment relating to plant. And we are saying that the fair value of the net assets exceeded the carrying amount. So this should be added. So we have 1,000 here and then also 1,000 here. It should be added, okay, to the carrying amount to be able to get our the fair value, because assets should always be carried at their fair value. Okay, at their fair value. So that is what we have. Now, because of the additional amount we are adding, this is going to give rise to depreciation. So we are going to have fair value depreciation. And with the depreciation, we've been told that the plant has a remaining useful life of 5 years. So we'll have 1,000 here divided by 5. Sorry. So let's quickly come here. And this is going to be affecting the amount at the reporting date only. That is what depreciation is recorded at the reporting date amount only. So we are going to have 1,000 divided by 5, and that will give me 200. And since this is depreciation, we are going to subtract it from the fair value amount of 1,000. And this same amount is going to affect our post-acquisition profit as well. So I can copy this and paste here as well. And this will be dash. Okay. So that is it about the fair value adjustment. Then we've been told also, now, as you already know, the net asset schedule deals with anything that pertains to the subsidiary. Anything that affects the equity portion of the subsidiary is going to be treated under the net asset schedule. So let's come to the notes again, and then we've been told that Albans actually received a loan. So let's look at it. So on the note 3 says that on 1st June 20x2, Saint lent Albans $1,400. The liability is recorded at the historic rate within the non-current liabilities of Albans. So since Albans has received a loan, all right, it has received a loan, and this loan will need to be translated. So how do we deal with that? So when it comes to the loan treatment, let's do a small calculation here. Now the amount was lent in dollars, so we have to convert it into D, okay, at the rate that was in place at the date of transaction, because the loan is actually is going to have an interest element that's going to affect the statement of profit or loss. So we are going to look at the amount in D or in dollars. So what do? We are going to have exchange gain or loss on loan received by our banks. So let me actually cut this and paste it here a little. All right, so how do we deal with that? We are going to have the initial recognition. So we have initial recognition, and with the initial recognition, the amount is 1,400, and we want to translate it into dollars or D. So we are going to multiply it by the exchange rate. The loan was taken on 1st June 20x2, and on 1st June 20x2, the rate of exchange in play was 3.9. So we'll multiply that by 3.9. This time we are converting the amount from the stronger currency into the weaker currency. So we are going to multiply it by the exchange rate. So we'll have that, and then this should be giving us 5460. Okay. Then at the end of the period, we are going to retranslate this amount because loan is a monetary item. It's a monetary item, so we're going to retranslate it at the end of the period. So we have retranslation of retranslation. Okay, and the retranslation is going to be 1400. So let me bring my equal sign there. Sorry, I'll bring my equal sign. 1400 times 4, because the exchange rate at the end of the period is 30th June 20x2 is $4, and $4 to $1. So I'll multiply that. Now it's giving me 5,600. So this is giving us an exchange loss. This means that at the end of the period, our banks is going to pay more than the initial recognition. So there's an exchange loss. There's an exchange loss of how much? 5,600 minus 5,460, and that will give me 140. All right. So this exchange loss, let me set some borders there. Sorry. So let me insert a border here. All right. So we have exchange loss of 140. Initially, the loan Albans was owing was 5460. But at the end of the period, when the loan was retranslated, it is now 5,600, which means that there is a loss of 140 to Albans because they're going to pay more than initially recognized. So that is an exchange. And when you come to the net asset schedule, you're going to put the exchange loss here. So we have exchange loss on loan retranslation. So let me just shorten that. And that is going to affect, once again, the amount at the reporting date. And since it's a loss, we'll have 140 and then negative 140 here as well. All right, so with this, I think we are done with the net asset schedule. So we can go ahead and find the totals. So I can come here, calculate that, and copy the results to the right using Control R. And then when it comes here, we'll have post acquisition, which is the reporting date amount minus the acquisition date amount. And so I can copy this across using Control D right there. So our post acquisition profit is actually 11,660, which I'll bold in right there and also insert my border there. All right, so this is nicely done. We are making progress. Let's continue. I want you to understand this so that when you see any question, you know exactly what to do with it. All right. So that is it for our net assets. We'll come back to it later to translate the amounts because these amounts are in dollars. So we have to translate them into dollars for us to be able to use them. So let's continue. Let's continue to the third working, which is working 3, and that is our goodwill. So we have goodwill. And with goodwill, we know that we are going to start with the cost of investment or the purchase consideration, as other books may put it. Then you are going to have the fair value of NCI at acquisition date. Then after that, we'll less the fair value of net assets. Net asset, that's also certain as NA, net asset at acquisition date. And then we'll have our goodwill at acquisition. We've been told that goodwill has been impaired, so we'll have an impairment loss, and then we'll have the impairment loss is actually at 10%, as we have been told in the question. So let me put my 10% here, and then we'll have our goodwill at reporting date. So this is the format for calculating our goodwill. All right, so let's come here. As I said, the goodwill will be calculated in the functional currency of the subsidiary. So I have my D here. So let's come. What is the cost of investment? From the question, we've been told that in the note number 1, we purchased the shares in Albans for $10,000 and dollars. Sorry. So we have $10,000. The fair value of the NCI at acquisition date has also been given to us. So in note 4, we've been told that Saint measures non-controlling interest at acquisition at fair value. The fair value of the non-controlling interest at Alban at the date of acquisition was $5,000. Okay, so we have 5,000 there. So we're going to add the fair value of the non-controlling interest at 5,000. We can add these two together. Then let me insert a border there. All right, then we have our fair value of net asset at acquisition. That can be found within the net assets schedule, and this is our net asset at acquisition. So this is the acquisition date net asset, they write down 3,000. So let me actually put a negative sign against it because we are lessening it. So minus there, and then we'll have our goodwill at acquisition. That's going to be the addition of these two. That is giving me 12,000 right there. Let me insert a top border there. And then we've been told that the impairment there has been an impairment loss of 10%. So this will be 1,200, which should also be a negative. Then we'll have our results now to be 10,800. Okay, $10,800 or dollars. D right there. So that is our goodwill. Okay, as simple as that. Now we need to translate we need to retranslate this goodwill or translate it, however you want to call it. So we have exchange gain. So we have exchange gain or loss on retranslation of our goodwill. Retranslation of our goodwill. So what do we have? Retranslation. So quickly, I'm going back to my notes to copy the format we have on the retranslation of goodwill, the pro forma here, and then you can copy that and use the figures as appropriate. So all right, so we have this, sorry. So I can paste that here. Okay, so what is the amount in the functional currency? So goodwill at acquisition date. What is our goodwill at acquisition date? From our calculation, we see goodwill at acquisition here, right here. So that is the value we are going to use here. So we have 12,000. And this should be translated. So quickly. With zero decimal places, they should also be calculated with 0 decimal places, and then our exchange rate will also be there. So goodwill at our acquisition date was 12,000. Our impairment loss is 1,200, which is a negative. So negative 1,200. And then this will be this, that, and then our goodwill at the reporting date is 10,800. All right. Then the exchange rate we are going to use. What is our opening exchange rate? The opening exchange rate from our question is 2.0. All right. So let me increase that. It's 2.0. The average exchange rate is 3.0 for the year. You can check that from the question. Okay, so let me increase this. It's 3.0. So for the goodwill at acquisition date, we are using the opening rate, then the average rate for the impairment loss, which is a profit or loss item, so 3. Then we have our balancing figure right there. So what do we have? We are going to have this amount divided by the exchange rate, and that was 6,000. And then I can copy this down using Control D. So that will be 400. And this one, our closing rate is actually 4.0. So we have that, and so the amount is going to be equal to 10,000 divided by 4.0, and that will give me 2,700. So what is our balancing figure? That is going to be our closing amount of 2,700 minus our opening goodwill of 6,000 minus the impairment loss, and that will give me negative 2,900. So this is actually an exchange loss right there. Okay, so that's our balancing figure. So this is how we translate, and this amount, this 2,900, the parent portion is going to be in a retranslation reserve, and then the subsidiaries portion is going to be in is going to be used in our NCI calculation. All right, in our NCI calculation. So that is how we do that. So we are going to share the exchange loss and the impairment, as you already know, the impairment and then the exchange loss, both to the parent and the non-controlling interest. So we've mentioned non-controlling interest, that is our workings for. So let's do that at once. So we have 4 non-controlling interests. All right, so with our non-controlling interest, what do we have? We are going to have the fair value of the non-controlling interest. So I can copy this and come and paste here. And for our non-controlling interest, we are going to translate the results into dollars. That one is done in dollars, unlike goodwill, where we have to retranslate. We don't retranslate non-controlling interest. So we are going to present it in dollars straightforward. So we have our dollars figure there. So since we are presenting it in dollars, we've been told that the non-controlling interest was $5,000. So we are going to divide that by this is at acquisition. So we are going to use our opening exchange rate of $2 to $1, okay, to get our dollar amount. So that will give us 2,500 right there. Okay, then we have NCI percentage of post acquisition profit. So NCI percentage of post acquisition profit, what do we have? Let me put the calculation here for you so that you can be able to get it right. So we know that the NCI percentage holding is 40% from our group structure. Remember, we are going to multiply that by the post acquisition profit, okay, which is 11,660. Let us go to our net asset schedule and confirm that. So this is our net asset schedule, and this is the amount of our post acquisition profits. This amount is in dollars. We are going to translate it into into dollars, all right, for the purpose of calculating our non-controlling interest. So the amount there is a profit item. So you are going to use the average rate of $3. All right, it's a profit or loss item. So you are going to use the average rate. So we come here and have divided by 3, which is the rate, and then we can close that. Okay, so that is what we do. So actually, supposed to be double. All right, so I can quickly come here and do that. So I have my equals 40%, which is 0.4 times bracket open 11660 divided by 3. I can close my brackets and have that. So that will give me 15555. All right. What again do we have? We are going to have the NCI percentage of impairment loss. The NCI percentage of impairment loss, and that will be equal to, what is our impairment loss? Is 400. This 400 here, that's the dollar amount, multiplied by 0.4, which is the 4%, 40%, 0.4, and that will give me 160 right there. And then we also have the NCI percentage of exchange loss, on goodwill. So that will be equal to, what's the exchange loss? Is 2,900 multiplied by 0.4, which is 40%. So that will give me 1,160. All right, that's 1,160. And then the last thing we will look at here is another thing which relates to retranslation on our net assets schedule. But we are going to do that later in our workings. So let's continue. So we are going to leave the non-controlling interest like this. Remember, we are going to retranslate our net assets as well. Usually, you can present that retranslation right under the net assets schedule. But in this example, we are going to present it as a separate working, as a working 6 or whatever. All right, so we have the fifth working, which is our group retained earnings. We have our group retained earnings. And with our group retained earnings, what are the items that comes here? We'll have, so let me cut this and paste here. So we are going to have 100% of Saint, which is the parent. We are going to have the parent's share of the post acquisition profits. We'll have the parent's share of impairment loss. Then we'll also have so there has been a mention of government grants, and we know that government grants are in relation to they are treated in the statement of profit or loss. All right, whenever there's a government grant, whether it's a revenue grant or capital grant, we are going to spread that over the period of the grant, and any expense relating to the period will be treated in our profit or loss account. And since this is the consolidated statement of financial position, we are going to treat all statement of loss items under our group retained earnings. So we have government grants here. Okay, we have our government grant here, and then we've sold goods to the subsidiary. So we are going to have a provision on unrealized profit also there. All right, so let's input the figures, some of the figures that we can, and move on. So I have my dollar sign here. This is also presented in dollars. So what's the retained earnings of the parents from our question? Retained earnings of the parents from our question is $4,000. So quickly we can insert that. We have $4,000. The parent's share of the post-acquisition profit is going to be 0.6. It's going to be 0.6 multiplied by 11,660 divided by 3. We have done that under our NCI calculation, so you can just do that, and that will give me 2332. Then we have the parent's share of impairment loss. That should also be equal to 0.6 times our impairment loss amount, which can be found here as $400, and that will give me 240. That is giving me 240 right there. Okay, then we have our government grants. Let's go to the additional information and see what they've told us about the government grants. Okay, so note 5. On 1st July 20x1, Saint received a government grant for 4,000. This grant was provided as a contribution towards the cost of employee and training over the next 2 years. So the grant is a revenue grant that was granted to Saint, and this is to be used to provide for the training of employees. So it means that we are going to divide this amount by 2, so that in each year there will be an expense amount of 2,000 each. All right, the grant was received to provide cost of training for employees. So for 2 years. So for each year, we are going to expense 2,000, which is the 4,000 divided by 2 for each year. And this has reduced its administrative expenses by the full 4,000. Okay, so that is how it is done. So we will come here, and in this particular year, the government grant is going to be 2,000. So we have equals 4,000 divided by 2 years, and that will give us 2,000. And since it's an expense, we are going to put a negative sign there for us to have the effect. Okay, so it seems I'm going to format the whole area here as an accounting figure with 0 decimal places. All right, so let's continue. Then we have the provision for unrealized profits. Let's go to the notes and see what items have been sold and what is the unrealized profits in the items. So in note 2, just before the year end, Saint acquired some goods from a third party at a cost of 800, which it sold to Albans. So Saint sold goods to Albans for cash at a markup of 50%. At the reporting date, all these goods remained in the inventories of Albans. All right, so how do we deal with that? The goods have been sold to Albans for $800, and a markup of 50% was added to it. Markup of 50% was added to it. Okay, so and the entire amount remained in inventory. So we are going to have, this is very simple. We are only going to pick the 50% markup, and multiply it by the amount that remains in inventory. And this 400 is our provision for unrealized profits. It's as simple as that. I have covered unrealized profits videos, issues in my previous videos. So if you are confused about how I treated this, you can check that out. All right, so that is what we have for our group retained earnings. And I don't think there's any other issue that will be treated here. So we can just add everything together to get our retained earnings amount. All right, now let's go to working 6. Working 6 is going to be the translation of our, so we have exchange gain or loss on retranslation of net assets. So as with the goodwill, I'm going to my notes and I'm going to copy the pro forma, and then we can just insert the figures. So I'll come here and copy this. Then I can come to my workings and paste it right there. Okay. Sorry, I didn't copy the entire thing, so let me go back. So let me copy this and paste right here. All right. So we have amount in functional currency, you have the rate, and then the translated amount. So what is our net asset at acquisition? What is our net asset value at acquisition? That can be found within our net assets calculation. So our net asset at acquisition is 3,000. Okay, it's 3,000. And that will be translated at the opening exchange rate of 2, as we have with the goodwill. Then we'll also take this 14,660 as the reporting date net assets and translate that at the closing rate as well. All right. And then there is going to be a post-acquisition profit. This post-acquisition profit will also be translated at the average rate. So we are going to pick these 3 figures and then we will do with that. All right. So let's go. So we have 3,000 for the opening amount. We have post-acquisition profit of 11,660. Remember, these are in the functional currency, which is dollars. Okay. And then we'll have the net asset at a reporting of 14,660. I hope I'm correct. All right. Then let me increase this, insert that, and reduce it to 0. Also do the same for this. All right, so we have that. Now, what's the opening exchange rate? Is 2. The average is 3. And then the closing is 4. So, sorry. Let me increase it to 1 decimal place. All right, so we are going to translate that. We have 3,000 divided by 2. So we have 1,500. And then I can copy this and paste the results. Okay. So what is our value at the end of the period? Is going to be equal to the closing value minus the opening value minus our profit, post acquisition profit, and that will give us 1722. All right, that is giving us 1722. Now that we have gotten the exchange losses, we can now prepare our translation reserve account. So we have translation reserve. So with the translation reserve, this is where you are going to put the group share. the group share of the exchange losses of the goodwill, as well as the group share of the exchange loss of the retranslation of the net assets. So let's come here. We are going to have our dollars. Let me put my dollar sign here. All right, so we'll have group share of goodwill retranslation. Now the NCI share has already been dealt with in the NCI calculation, and then we also have group share of net assets retranslation. All right, so we have equals the group share of the goodwill retranslation. Let's come to the goodwill. This is the amount multiplied by 0.6. Okay, 0.6, and that will give us the group share. Then the group share of the net assets retranslation to goes as 0.6 multiplied by this amount, and that will give me 1000. That, so I'm going to add these two together, and that will give me the total translation reserve amount. Okay, the total amount in our translation reserve. So that is 27730, and this is actually an exchange loss. Then, as we have done for the group, let's go and do the same for the NCI calculation. So as I said, there is an item within NCI that we haven't dealt with. So let me cut this and bring it down a little. All right, so we also have NCI percentage or share of net assets retranslation. Net assets retranslation, and that will be equal to 0.4 times our retranslated amount, which is 1772. So we have that. Okay, there's a mistake here. This is exchange. All right, so we have that right there. All right, so we can now calculate the total NCI value. So using this, I can add those together, and that will give me 2046. Okay, 2046. Let me set my border there. Okay, so let me cut this also and paste it here. So that is it for our translation reserve and the exchange gains or losses. These are the main focus of this particular video. So make sure you understand whatever I am doing here. All right. Then we also have, that is all we have for now. So let's go now to our pro forma statement of consolidated financial statements and populate the rest of the figures. So we have so the property, plant and equipment, we've been told that an amount of 1000 was in excess of the carrying amount. So what do? We are going to adjust for the depreciation. All right, we are going to adjust for the depreciation. So we'll have equals, and what I'm going to do is to have my 1000 here, which is the amount divided by 4. We are translating it at the closing rate of exchange, and then we are going to subtract the depreciation amount of 200, also divided by the 4. All right, and that will give me 200. All right, so we have that. Then our goodwill, the goodwill has been calculated, and we had how much? We had 2,700 right there. Let's go and check that out. That is our workings 2,700 right here. Okay, at the translation column here. So we have 2,700 there. And then I think that is all for our assets. So we can now find the total assets. 28,615. Right. But if you follow this particular video carefully, you realize that you have missed something. And you should be able to identify that. You could see that we didn't adjust for the intertrade between the parent and the subsidiary. So there has been a provision on unrealized profits. So you have to subtract that from our inventory. So the provision was, I think, 400. So quickly I'll put my 400 here, and that should give me this amount. Okay, so that is it. I think that is it. So quickly I can come here and put here W3. Okay. Okay. So that is it for the assets. Let's come to the equity and liabilities. So for our retained earnings, it was W5. Well, workings 5. So I'll put my workings 5 here, so that when the examiner sees the amount, he knows that, okay, this amount was gotten from this particular working. So the examiner can refer to it and know what exactly you are doing. This was working 6. This was workings 4. W4. All right. So let's go and fix in those figures. So for our retained earnings, we have 3692 right there. And then for our translation reserve, it is also there. Translation reserve, which is working 7, is also here as that. And then we also have our non-controlling interest, which is our workings 4 here, right there. So we can add everything here together. So using alt equals, I can sum up all of these together, and that will give me 15,965. So let me insert top border. All right, then for our non-current liabilities, there has been a loan. All right, there has been a loan, and there has been a retranslation of the loan. So let's see how we are going to adjust for that. We've been told that from our calculations, there has been an exchange loss of 140. So that's 140. This loan is actually an intra-group transaction, so the exchange loss that was recognized has to be eliminated. All right, has to be eliminated, including the actual loan amount of 1,400. So we would have we are going to have the exchange loss, which we have to add back, okay, any loss that we obtained or that was obtained as a result of any intra-group transaction has to be added back. So we have 140, and this should be divided by the closing exchange rate of 4, and then we have to eliminate the actual loan amount of 1,400. Okay, have to eliminate that. So our non-current liabilities are actually this amount. 5,000 right there. Then when it comes to our current liabilities, the current liabilities, we have a 1 year revenue in advance, which is the government grant. So we have to add that to our current liabilities. So we have the 2,000 here. That is actually the 1 year revenue grant, because 2,000 has been expensed in this current year in our retained earnings or in profit or loss. So the remaining amount will be a liability for the next accounting period. And since it's a 1 year item, it is a current liability item. So that is the adjustment we do for our current liabilities as well. So we can add these three together and see what we've got. So we have 28,215 as the balancing figure right there. So as you can see, our consolidated statement of financial position has balanced correctly. So this is how you deal with foreign subsidiaries in consolidation. All right, I hope you have learned a lot in this video. This video has been a long one, but I hope that I was able to touch on everything you need to be able to confidently face any question that will be presented, and that will involve a foreign subsidiary. With the key issues treated in this particular video, you should be able to deal with any foreign subsidiary consolidation question you find in your exams as you prepare for your professional or any other exams, financial reporting or corporate reporting, or even the strategic business reporting in ACCA. All right, so thank you very much for your time in this particular video. I hope you have studied a lot. Don't forget to subscribe to the channel, and also don't forget to like the video and leave your comments in the comment section so that you can follow along, so that I can look at them and know exactly where to touch in my next videos. All right, so thank you very much. I'll see you in my subsequent videos.